If you're trying to build wealth while minimizing taxes, you're probably focused on 401ks and IRAs. But there's another account that offers better tax advantages than either of those, and most people either don't know about it or are using them incorrectly. Health savings accounts, not to be confused with flexible savings accounts, which are use it or lose it, stay with you as long as you have the account. And it provides a triple tax advantage, something that's extremely rare in our tax code and infrequently found anywhere else. In this video, I'm going to reveal why health savings accounts are the most powerful wealth building tool that almost nobody leverages to the fullest extent possible, the 4 specific hacks that could save thousands in taxes, and the receipt tracking system that creates a tax-free ATM for your future self. First, let's cover what exactly an HSA is and who qualifies. As the name implies, a health savings account is a special savings account for your healthcare expenses. The first tax advantage is tax-free going in. Any money that you put into the HSA is not taxed, and those dollars you contribute lower your taxable income. If you make $100,000 a year but put $5,000 into the HSA, when you do your taxes, you only show $95,000 as income, all else remaining equal. So HSA contributions reduce your taxable income dollar for dollar. Second tax advantage here is tax-free coming out, as long as it's used for health expenses. Any money that you pull from the HSA and use for qualified medical expenses is not taxed. So you aren't taxed on any of the money going in, you aren't taxed on any of the money going out. The IRS can never touch this money again. The third advantage here is that any growth on your HSA dollars also is not taxable. So let me explain what this means. Consider looking at your health savings account as a health investment account, because you can place the dollars in your HSA into actual investments, usually above a threshold of $1,000, and allow them to grow over the next 10, 20, 30 years from that account. And the growth from investing is not taxable if you pull out at any point in time in the future, meaning you can reimburse yourself from an expense that happened 20 years prior as long as you have documentation of that expense that you paid out of pocket. There are no timelines of reimbursements from the account. So if we talk about how to actually leverage the HSA the best, number one would be considering investing the HSA dollars. Your HSA administrator will have investment options for you where you can pick the funds based on your risk profile and the time that you have to wait. And then you can invest your HSA dollars to grow over time. Your administrator is not to be conflated with your insurance company. Those are two different companies. So what difference does investing that make? On the left, you'll see Eric, the saver. He maxes out his family HSA contributions each year and every year starting in 2025. And this continues for 30 years. He didn't know that he can invest his HSA money, so he just leaves it in a savings account, doing what 91% of people do. For this example, let's assume Eric and his family never reimburse any health expenses for 30 years. I know this is unrealistic, but stay with me. After 30 years, his HSA balance is right around $370,000. This is $370,000 of tax-free wealth that he can tap into for his future expense that is largely his second largest expense, shy of taxes, being health expenses. Now on the right, we have Eric's alternative universe self, Eric the investor. He watches this video where Eric the saver did not, and after watching this video, Eric the investor made the same contributions over 30 years, but he invested those dollars instead of having them sit there in a savings account getting next to no interest. If he returns an average of 7% growth over that time, which is relatively conservative based off of the historical performance, which is no indication of future performance, and after 30 years, Eric the investor's HSA has about $900,000 in it. That's $500,000 more than Eric the saver. Over $500,000 more, and this is something where they will not automatically invest it like your 401k may be. So if you do not know if your HSA funds are being used or invested, they're probably not. And fun fact, once you've hit 55, you can actually contribute $1,000 more than the annual maximum amount. These are called catch-up contributions, and the big numbers that I just gave don't actually include the additional amount. The second HSA hack is to not use your HSA for medical expenses every single year. That sounds like pure craziness, but the logic behind it is this. Looking at the alternate universe, Eric, again, we now build in a $2,000 per year of medical expenses for the families of both Erics. After 30 years, Eric the Saver's HSA is $60,000 lighter than before, and now he only has $310,000, which again, let's be honest, it's absolutely awesome. However, there's a huge opportunity that he missed. He's leaving money on the table without knowing it. Eric the Investor had the same scenario. However, Eric the Investor approaches this differently. When he gets a qualified bill over $20, because he can't keep up with low bills and receipt management, like the $2,000 he had to pay for his daughter's braces, instead of using the HSA, he keeps that $2,000 invested in the HSA and pays for the braces out of pocket, leaving the HSA dollars alone to grow. But he keeps the receipt. Looking at those $2,000, let's pretend that was the first year in 2025, invested with the average 7% over 30 years. Yes, that could potentially turn into $15,000 over time. And by not using the HSA for these expenses and continue to max out his contributions over 30 years, Eric the Investor again has $900,000 in his HSA. But he can turn around and reimburse himself from that account with the $2,000 receipt that he kept in a centralized location with all of his other out-of-pocket medical expenses that he did not use his HSA for. This is the HSA bank account receipt that he is drawing from, while all along the way the account was shielded with tax-free growth. If you do not have money to pay for medical expenses out of pocket and you must use your HSA, absolutely do it. There's a difference between theoretical optimized examples and real life. Bad years happen, we lose jobs, or we go through tough times, and just coming up with these dollars may not be realistic, but you will still benefit from the deduction in the existing year. The third hack we alluded to, which is the receipt strategy, and it feels like cheating because there is no time limit on when you can reimburse yourself from past medical expenses using your HSA. I'm saying you can reimburse yourself for any medical expense that happened while you had your HSA at any point in time, as long as you have documentation of the receipt. Our fourth hack here is that once you turn 65, you can now use your HSA dollars for much more. It essentially turns into a traditional IRA account of sorts, where you can pull the dollars for whatever you need and you don't have a required minimum distribution like a traditional IRA. It's like your HSA funds grows and become a full retirement account if you were to need it for that and have a robust enough amount. Now, any money that you use for non-qualified medical expenses will go towards your taxable income, but you won't be penalized on top of that after this age. And once in retirement, there's a lot of flexibility if you plan right to control your marginal tax rates. The last benefit that I'll throw in here as a nerd note is that if you fund your HSA through your employer's payroll plan, you actually avoid 7.65 of Social Security and Medicare tax on your contributions. This is a secret fourth tax advantage that most people don't necessarily mention, but it's worth touching on. That's an additional $317 in savings on a maxed out HSA contribution for individuals or $654 for families. But the critical part that most people miss is that this benefit only applies to payroll contributions, not direct contributions you make outside of payroll. Said another way, you'd like to try to put it through payroll if you can, because it saves you an extra 7.6%. This means best practice should always maximize your HSA contributions through your employer's payroll system. And if you need to in the new year and you noticed that you did not fully maximize it, you can always top off your contribution up to the maximum amounts before April 15th of the following year. Since we're talking about 65, that means Medicare eligibility. And one downside to HSAs is that they do not play nice with Medicare. This is particular for Part A Medicare. Once you have any of Medicare, yes, even just Part A, neither you nor your employer may continue to contribute to your HSA. This trips up more people than any other HSA rule. You can actually opt out of being automatically enrolled in Part A, but that's something that you need to be aware of when you get closer. Based off of this analysis, here's your specific implementation strategy. Step number 1, verify HSA eligibility through your health insurance. Look for HDHP or HSA eligible designations. If you're not sure, call your HR department or insurance provider directly. Step number 2, maximize your annual contributions if you're able to through your employer's payroll system to capture your Social Security tax savings as well. Step number 3, invest contributions in low-cost funds for long-term growth. This is going to be nuanced and specific to everybody's risk tolerance and situation. Consider not letting your money sit in a savings account earning basically nothing. Most administrators offer investment options that you should consider using. Step number 4, pay current medical expenses out of pocket when your cash flow allows. Every dollar you leave in your HSA is a dollar that can grow tax-free for decades. Step number 5, implement a receipt tracking system, even if it is a gallon Ziploc bag that says HSA expenses on it. And step number 6, sit back and let your account grow. This is a marathon, not a sprint. The HSA isn't just a health account, it's a wealth building machine disguised as a health bank account. When you understand how to use it like sophisticated individuals do, you're looking at thousands of dollars in future tax savings. You're finally playing the same game that the wealthy do. Hopefully you enjoyed this video, and I'll see you in the next one.